And for more on the markets, let's bring in Jim Paulsen, author of the newsletter Paulsen Perspectives and former chief investment strategist for both the Luthold Group and Wells Capital Management. And Jim, it's great to see you this morning. Thanks for coming on.
You bet, Mike. Great to see you.
So talk about, I don't know, how the first almost month of the year has unfolded, both in terms of, collective expectations for this magic combination of a pretty sturdy economy and maybe rates off their highs and with room to cut and earnings are growing. It seems as if kind of all cylinders firing on the bull case, but you think maybe there might be a little bit of a scare along the way?
I do, Mike. I think one of the reasons is just what you bring up. I think in some sense the sentiment, the feel today is calmer than it's maybe been in this entire bull market. I mean, this bull market has lived under the haunting image of the Fed tightening all the time. It's constantly and chronically had imminent recession forecast almost always in place, kind of climbing a wall worry. Last year, we had a war in the Middle East, a war in Ukraine, a war for the White House, and a lot of those seem to be calming down. And there's now a new era with the golden era with the new president and good feel. And there's a sense the economy not only is not weak, it's almost too good. And it just bothers me a little bit that sentiment's kind of got there. And that tells me that it could be upset if it comes in a little differently than that. I'd also point out that the third year of a bull, which we're in, historically back to 1945, Mike, is not that great. Historically, returns have been about 5%. The frequency of corrections are much higher in the third year than they are in the first and second. And then lastly, what concerns me the most is just, economic policies have really been tightening a lot lately. Not only bond yields up 1% since the mid-September, but also the dollar, the real value of the dollar is almost at an all-time record high now, dating back to when it was first floated in the early 1970s. Money growth is just a little over 3%, which is insufficient to support a 5% nominal GDP. And fiscal juice has been flat, even though the economy has continued to slow, which means that it's gotten tighter. So I think we're going to slow the economy down, and I don't think we're going to have recession. But I think we might reignite some recession fears, and I think it's going to come as a surprise now that everybody thinks the water's safe, so to speak.
It's interesting. The Fed, obviously, they've cut 3 times. We're going on a sort of a hold pattern for the moment, it would appear, in part because they feel as if the economy doesn't need any help and they want to allow inflation, maybe if it's going to continue to come down, to do so, or if we do get a little bit of a spark, whether it's from policy or elsewhere, to inflation to perk up, they can maybe just hold things here for a bit. Do you think that there's risks involved in them pausing? Because, historically, if the Fed's going slow, if they've just done some adjustment rate cuts and then let the economy breathe, it usually is okay, but you feel like that's a little risky?
I do, a little bit. This Fed has kind of been behind what all the other policies have been doing throughout this cycle, Mike. The inflation started rising from 0.5% in mid-2020 to 9.1% by mid-2022. And while bond yields went up and the money supply came way down and fiscal juice tightened and the dollar went up, the Fed didn't start tightening until the inflation rate was 8.5% in April of 2022. And so it kind of eased all the way up while everything else was tightening. Then when inflation came down, all the other policies started easing and the Fed kept tight. And I think kind of now the Fed started easing and all the other policies were tightening. Ever since mid-September when they've started their easing campaign, everything else has been a tightening force. And I'll tell you what, it's been more important if you follow the other policies than to follow the Fed. That is to say, the other policies have been right and have kind of shown the path ahead, not the Fed. The Fed's been behind the other policies and been wrong. So in some sense, when the Fed didn't tighten, you wanted to be prepared for tightening and slowing. And when the Fed was tightening, you wanted to believe there wasn't a recession. And now, again, I think the Fed's behind the curve still. And I think this time, with the economy now slowing down to 5% nominal GDP growth, it's risking staying too tight too long, particularly when all the other policies are tightening as well right now. So I just think we have a chance here that we're finally going to get back to a recession scare before this year is over. Have a correction. I don't think we're going to have a fair market because balance sheets are too strong and liquidity is too ample. but I think we could have a pretty good recession scare, maybe a 10% correction.